Hello friends, my name is RISHI UDESHI. I'm in the field of teaching and mentoring civil service aspirants since last 6 years, and I have been associated with several private as well as state-run organizations. On our channel UPSCpedia, we have started a revision cum crash course for different parts of your syllabus. Today we'll be dealing with economy, and in this revision lecture, we'll also at the tail end of the lecture we'll be discussing the previous year's questions, which will give much needed confidence to the students right now. So let's begin with the lecture and let's start. The first topic today will be national income. So this is my channel UPSCpedia, and this is the topic national income which we'll be dealing with today. And my name is RISHI UDESHI, and this is my email ID. Just in case if you have any kind of doubts or anything, any queries if you want to ask, you can always drop me an email here. Let's begin. Let's go to the next slide. So the contents we'll be dealing with today will be primarily national income. What does it mean? Its type: GDP, NDP, GNP and NNP. Apart from this, we'll also be understanding associated terms like factor cost, market price, real income, nominal and disposable income, and other such terms. And also we'll be understanding the GDP deflator as a topic, as a concept. It's an important concept, GDP deflator. We'll also be understanding that. And at the tail end of the lecture, we'll be discussing previous year's questions. So let's begin. Yeah, so the first topic, national income. What is national income? National income is nothing but the measurement of the economic growth of a country within a specified period. That's nothing but national income. Let's try reading it. National income, it's nothing but the net result of all economic activities of any country in a period. Remember, it's a period of 1 year and valued in terms of money. So it should be valued in terms of money. It should have a specified period. Let's move ahead. This introduction is not that important. This definition, of course, will not be asked anywhere in the examination. What will be asked in the examination, civil service prelims, will be GDP, NDP, GNP, NNP. So these are likely to be asked. Let's try and understand these concepts more in detail. And beginning with GDP, it stands for gross domestic product. Gross domestic product. And I have underlined a few key words in this definition. The key words are gross, domestic, then there is final as a keyword, then there is boundary, which is a keyword. Period is a keyword. Period is a keyword. So these are the important keywords, of which few keywords we'll be dealing with now, right now, and few will be dealing with later in the same lecture, but in the later slides. The keyword which we'll be dealing with now is the word final, then the word period. These are the two keywords we'll try to understand right now. And what do we mean by the word final? In economy, there are several goods which are intermediate goods. They are not final goods. For example, if you consider wheat and if you consider bread. So wheat, the farmer who sells the wheat to the wholesaler, that will be an intermediate good. The wholesaler will sell this wheat to a flour mill. That will still be an intermediate good. The flour mill will sell this wheat, this flour, to a bakery. That is still an intermediate good. And finally, it goes to from the bakery's hand. From bakery, it goes to the final consumer. That is the final good. So we have to consider the value of that final good, not the intermediate goods. Why? Because if we keep on considering the value of each of the intermediate goods, there will be double counting of the same product, which doesn't make any sense. We'll be increasing our national income estimation. So that's not required. That's not precise. So exactly to measure one product only once and not allowing double counting, that's why going for what? We are going for final value of goods and services produced. Remember, it's goods and services both. Apart from this, the other keyword which we are going to understand right now is period. The national income cannot be measured in general. It has to be within some specified period. Now this period can be quarterly, it can be yearly, it can be for 6 months. So it can be either of these things. But remember, it is always a certain period within which you try to measure the national income and to be GDP to be precise. Apart from this, one of your papers, since we'll be looking at the previous year's questions in the later slides also, in one of your question papers, they had also asked one more definition of the GDP, and that is something which is to deal with the second definition of GDP. Let's try to understand this and read the second definition. It says that it is also calculated by adding national private consumption. So basically there is C, stands for consumption, gross investment, so then there is I, then there is government spending, so then there is something called as G, and the last is trade balance. So trade balance. So that is another definition. Let me just write it more precisely here. So it's is nothing but C plus I plus G plus X, I mean exports, minus imports. So this can be just another definition of GDP which can be mentioned. Moving on, let's go to the next point. The other point is, it is nothing but a quantitative concept. It is a quantitative concept. Why it is a quantitative concept? This again will be understanding in the very, like in the latest slides, quantitative concept. So the terms which are yet to be discussed are gross, the other is domestic, then there is boundary, and then there is this quantitative concept. These are the terms which are yet to be discussed. We'll be understanding them. And this we know, we already know, like every time we read in news what is the economic development of a particular country, we keep on comparing every country's GDP with the other country's GDP. So that's something which we are already aware. Every international organization like World Bank, IMF, all these organizations, they keep on comparing the GDP value of each of this country for comparison between countries worldwide. So it is used heavily for comparison between the countries worldwide. Moving on to the next slide. The next slide is about NDP. NDP stands for Net Domestic Product. Net Domestic Product here is something where we'll be understanding the meaning of the word gross, which we had skipped in the previous slide. So there was something called as gross in the previous slide, and here the gross word has been replaced by net. What is the actual difference? The actual difference is here in the second point. It says that net is equal to gross minus depreciation. It's nothing but gross minus depreciation. And what is depreciation? Depreciation is nothing but the decrease in the value of goods over a period of years because of the natural process of wear and tear. Every product, everything which is produced, it always undergoes wear and tear. It is accounted in the form of depreciation. So this is nothing but NDP, Net Domestic Product, wherein you reduce GDP with depreciation. Now let's try understanding the other points of this. NDP is more practical. Yes, why? Because it considers a reality and the truth of life, of depreciation, of wear and tear. Then it is less reliable. Why is it less reliable? Because the rates of depreciation, they are decided by individual governments. So India will decide what the depreciation rates will be for each of these products. Similarly, China will decide the depreciation rates for each of these products. US will decide the rate of depreciation for each of these products. So it is something which is less reliable. Why? Because it cannot be used for cross-country comparison. Every country may be having a different parameter to measure its depreciation. So that may be a possible concern for this. Apart from this, hence, see, so that's why we have written it that there is no international comparison with the help of NDP. We don't go for international comparison with the help of NDP. Why? Because depreciation rates are decided by individual countries. Now, individual governments of these countries, they decide the depreciation rates. This, apart from being less reliable, they are also a way in which the government hints the market what the government wants the market to do. For example, if in case government increases the depreciation rates on cars, it means government is signaling to the markets that the cars you purchase this year, they'll be having higher depreciation rates. The value will be decreasing every year drastically. So basically government is asking the market to go for production and purchase of newer cars. So that is at times used by the governments across the world to signal to the markets also, to signal to its economies also. Moving on, it is a qualitative concept. It is a qualitative concept, and because of course if the quality of the goods will be high, the depreciation rates will be less. So that's why it is a qualitative concept, and also shows the R&D development of a country, how far the country is able to reduce and minimize the wear and tear in its product, how far the country is able to produce its quality products so that they do not meet that much depreciation rates. Moving on, the next slide, I hope you are clear with this. The next slide is GNP, Gross National Product. Here we'll be understanding the meaning of the word domestic, which we had learned in the first GDP slide. So it was GDP. D there stood for domestic. Here the difference is national. There's a difference between domestic and national. Gross National Product. So what is the difference here? As we can see in the second slide, here it is GNP is nothing but GDP plus or minus income from abroad. It's nothing but income from abroad. Basically try understanding this. That if in case there is a resident in our country, if there is a resident in our country who is a foreign national, but is a normal resident of our country. He is a normal resident of our country. What is normal resident? We'll be understanding them in the later slides. It's not that important right now. But try understanding this. There is a resident in our country who is a foreign national. He holds a foreign citizenship, maybe a US citizenship, but his primary economic interest lies in India. So that individual's income and that individual's contribution to the economy will be considered in the GDP. It will be considered in the GDP, gross domestic product. Why? Because here we are understanding the significance of the word domestic. Significance of the word domestic, wherein we try to primarily give more importance to the concept of boundary. That's again an important word which we had skipped in the earlier GDP slide. That's nothing but it gives the reference to the word boundary. Boundary. It gives importance to the word boundary. What do we mean by this? So GDP, the one which we read in the previous slides, GDP considers domestic and the boundary very important, and that's the reason why it will consider the economic contribution of a foreign citizen also ordinarily resident in India with major of its economic interest in India. It will consider its economic contribution also, whereas the GNP, gross national product, will consider the economic interest, economic contribution of its citizens only, not of the people who are not the normal residents of the country. For example, if there is some Indian who earns something in USA, for example, if there is an Indian who earns, he is based in California, he is based in Silicon Valley, he is earning there, he is an engineer, he is earning something there, and then he is sending that income back to India. So that income will be considered in case of GNP, gross national product. I hope you are understanding this. Let's try to understand this, that it will be furthermore clear in the upcoming points. Income from abroad includes private remittance. Remittance, what is remittance? Remittance is nothing but the transfer of money from an individual who is a citizen of India, who stays abroad but is sending money back to his family. That is nothing but private remittance. The next is interest on external loans. That is also a part, that is also a very important, crucial part of income from abroad. And the last is external grants. So if there is some international organization, maybe IMF, World Bank, or any other ADB or AIIB or any of these organizations, they are willing to make any kind of contributions to India, which is without any kind of liability, that is nothing but an external grant. And with these, like either external grants or private remittance or interest from external loans or any of these things, there is always a transfer of money from the country outside or from outside within the country. This transfer of money should be measured. Which side the transfer of money is higher? Now, usually in case of India, the transfer of money out of the country is more as compared to the transfer of money within the country. So that's the case of India, and that's the reason why in case of India, the income from abroad is primarily a negative value. And that's the reason why here, since we have written both positive and negative, actually it will just be negative, so we can write it somewhere at the bottom of this page. Maybe we can write it here as GNP is equal to GDP minus income from abroad. So I hope you're clear with this. There won't be a positive sign here. In case of India, it's always less. GNP is always lesser than GDP. I hope you're clear with this. Let's go to the next point. The next point says GNP considers nationality. It doesn't consider the boundary. As we just discussed, it doesn't consider the physical boundaries if the individual is within India or outside India. It considers the nationality of that interest of that individual. It doesn't consider the boundary. So even if there is an individual, Indian individual outside India, possibly there in US, will still consider his economic contribution in our national income calculations in the form of GNP. The next is, in case of India, it's always negative. It is always negative. Fine. So moving on, let's go to the next slide. The next slide talks about NNP. NNP stands for Net National Product. Now it involves the definition and the concepts of both of what? Of net as well as from domestic to national. That's something which we understood in the previous slides. So basically it is net. Since we have included net here, there will be decrease of what? Depreciation. There will be decrease of depreciation. And since we have included national also, there will be income from abroad factor also. So it's NNP is nothing but gross national product minus depreciation, and NNP is nothing but GDP minus income from abroad minus depreciation again. Moving ahead, this NNP is said to be the purest form of national income. Is said to be the purest. In general, all these four terms were actually a part of national income, but NNP is considered the most pure, the purest form of national income. Moving ahead, per capita income is nothing but, what is per capita income? It is nothing but national income divided by the population of that country. Fine, so it is national income divided by the population of that country. So let's understand the next slide. The next slide is about associated terms. Let's understand more about it. And this is dealing with the topics like factor cost and market cost. Let's try to understand this in more detail. Let me just zoom in. Okay, let's understand about this. So in an ideal economy, there is a producer who is at the factory's end, and then he produces something and he sells it to the consumer in the market. Usually the cost at which he produces is the cost at which the consumer purchases. Now that cost involves everything which the producer has incurred the cost of. So it may incur the cost of the rent on the land on which he has produced the good, the power he required to produce the good, the capital and the interest on that capital he has given to produce the good, the profit which he wants, which he expects from the good. All that thing is at the output of the factory, and all that thing is the cost of the good at the output of the factory. And then comes the real world scenario, wherein in the real world scenario we see that between factory and the market there is one more player, which is the government. Government is also one of the players. So now there is a difference between the cost of the good at the output of the factory and cost of the good at the market. The cost of the good at the market and the cost of the good at the output of the factory. So now there is a difference between both. Why is there a difference? Because an intermediate player has been added. The player is the government. Now this is across the world, and this player usually changes the value between output of the factory and the market by two tools. The tools is taxes and subsidies. Let's understand this further. The cost at the output of the factory is called as factory cost, and the cost at which the consumer purchases is called as market cost or market price. So if we make an equation of this, the equation is something like this, that factory cost, that is the cost at the output of the factory, plus there will be some taxes which will be added to the product. Why? Because the government will involve some taxes, government will levy some taxes on these goods, which will be usually indirect taxes, and in the case of India they are GST. And also government will reduce the cost of the product by giving some subsidies. Now what is subsidies? Subsidies is nothing but government makes an attempt to make few goods affordable to the larger section of the society. How does government do this? Government basically, if suppose there is a good which costs somewhere near 500 rupees, let's assume LPG. So if there is an LPG which costs around 1000 rupees and the government will give around 500 rupees as subsidy on it, so ultimately what the cost of the good will be? It will be 500 rupees in the market. Why is government doing this? The government is doing this to ensure this thing, that the LPG becomes affordable to the larger sections of the society. So there on the factor cost, there will be addition of taxes and there will be subtraction of subsidies, which ultimately will give you market cost or market price. So that's the difference between both. Now either you take this on this side of the equation, so if you have FC plus taxes minus subsidy, you can write M market cost, or you can write the other way around, you can write market cost minus taxes plus subsidies, you can write factor cost. So either of the two formulas which you can adopt. Are we clear? So let's read about this further. Okay, the first point says that it is basically the factor cost is the input cost of the producer which he has to incur in the process of producing something, which involves the cost of the capital, the interest on the loans, the raw materials and the labor, the rent and the power. All this cost plus the profit which he wants from the product, all this is added and the factory cost is decided, or the factor cost is decided. Then comes the market scenario. In the market cost, which is nothing but the price of the goods at the showroom, and this is also called as the X factory price. Do remember this. This is also called as the X factory price, and on which the taxes and subsidies are added. So these are two things which changes the cost at the output of the factory and the cost at which the consumer purchases. These are the two things which changes the factory cost and the market cost. Now if you look at the formula below, it's nothing but the formula we have written here. So national income at the factor cost or the factory cost is nothing but national NNP at the market cost minus indirect taxes plus subsidies. Since we have brought it on this side of the equation, on the RHS, if we would have taken this indirect taxes on the LHS, this would have been plus taxes and minus subsidies. So I hope we are clear with this topic. Let's move on to the next topic. The next topic is about the nominal, real and disposable income. Nominal, real and disposable income. And for this also, let's consider one example. Let's consider an example. Let's consider a monthly salaried individual, and suppose in the first year his salary was around rupees 100. His salary was around rupees 100 and his expenses were roughly around 50. His expenses were roughly around 50. So expenses, I mean the expenditures he make, and this is nothing but his income. So this is income and this expenses were around 50. Effectively he was getting 50 in his hand. He was getting 50 rupees in his hand. The next year his salary increased by 105. But at the same time the expenses, since there is inflation in the real world scenario, the expenses also increased, and since the expenses increased, it became 55. The same goods now cost more, so it became 55, and still he gets around 50 in his hand. Again, let's consider if suppose on the third year he gets 110 as his salary, but now the expenses again has increased. The expenses has become 60 rupees. Ultimately what he'll be getting in his hand? Again 50 rupees. So this is increasing every year. His income is increasing every year, but so is inflation, that is expenses increasing every year. So we can see this thing, we can notice this thing, that this is the nominal income. This is nothing but the nominal income. The nominal income, which is increasing every year. And when you remove the effect of inflation from it, what you realize that actually his income is not increasing. The real income is the same. His expenses of the same products, the expenses are increasing because there is a high inflation in the economy. So nominal income may seem to be increasing because of the increase in inflation, but the real income is the same. Let's further understand this. So if I can write some short formula here, nominal, if you remove the effect of inflation from this, you get real. From nominal income, if you remove the effect of inflation, you get real income. Further from this, if from the real income, if you remove taxes from this, you get disposable income. And that's the concept of all these three terms. Nominal income, you have to remove the effect of inflation, you get real income. And from real income, if you remove the effect of taxes, you get disposable income. Let's read the slide. The slide says that nominal income is nothing but the wage someone gets in his hand per day or per month. That's what we assumed in our example. The real income is the nominal income minus the effect of inflation. So if you remove inflation from the nominal income, you get real. So that's the real income. And the last is disposable income. In disposable income, that is nothing but net part of the wages which is free to be used by him, deducting all the direct taxes from him. So basically you are removing the direct taxes from the real or the nominal income, and finally you get the disposable income. So you have to remove the taxes. Direct taxes, what do we mean by direct taxes? They are nothing but the income tax which an individual pays, or if it is a corporate, it pays a corporate tax. Those are nothing but the example of direct taxes. So I hope you are clear with these three terms. So now let's try to understand the concept of base year. Before going more into detail of this concept, we'll have to think about one particular topic first. It will be about GDP. So we have already discussed GDP, and from that definition you already know that in the definition of GDP we had mentioned that it's nothing but the sum total of final value of goods and services produced within the domestic boundary of a country within a specified year. And from that we know we are measuring, not measuring the number of goods, we are measuring the number of goods in its monetary value. So every good which is produced, the amount of goods, the number of goods will have to be multiplied by the cost of each good to finally know what is the GDP. And this will be done for all the goods. This will be done for all the goods. So that will give us the GDP figures of that year. Now, before further going into the concept of base year, let's understand one example. Let's take one example. Hypothetically, let's assume this thing that we are measuring the GDP of the country in 2015 and 2019. In these 2 years, if we have to measure the GDP of the country, basically what we need to do, we need to multiply the number of goods by the cost of each good to get the GDP figures. Number of goods multiplied by the cost of goods to get the GDP figure. Let's assume between 2015 and 2019 the country has made no progress and is making equal amount of goods. But the cost of goods has increased from 10 rupees earlier to 12 rupees. So now the GDP will be increasing from 100 rupees to 120 rupees. And in this ideal scenario, we know this thing that no national wealth has been increased. India was producing 10 earlier, India is producing 10 now. Actually, there is no value addition to the country. It's just there is increase in the cost of goods, and that's the reason why the GDP is increasing. So it's just because of the cost of goods, or we can say inflation, that the country's GDP is increasing, and that at times brings the hype in the GDP. So what will we do to solve this problem, to make cross-year comparisons of GDP, and to solve these problems, we have devised a concept of base year, and we usually give the prices of the commodities based upon the prices of the commodities of that base year. So in our case, in the case of India, we have base year as 2011 and 2011-12. This financial year we have decided the country's base year, and based upon this base year prices will multiply the number of goods. So if in this year the cost of the goods was 5 rupees, not even 10, not even 12, the cost of the goods was 5 rupees, so we multiply 10 by 5 and we get 50 here. Again in 2019 we multiply 10 by 5 and we get 50 here. So now with this precisely we precisely know that actually there is no value addition in the country. The 10 rupees has there were 10 goods being produced earlier. The 10 goods have been produced even right now. So there is actually no value addition. The only rise in the GDP was because of the rise in the cost of the goods. So now we have decided a base year whose prices will be designated as the prices which will be used for the calculation of GDP. Are we clear? So, and this is nothing but the concept of current prices and constant prices. This is nothing but the concept of current and constant prices. Just read this statement and you'll realize this. Estimates at the prevailing prices of that year. So if we multiply the number of goods of 2019 multiplied with the cost of the goods in 2019, those kind of estimates will be called as current prices. They will be called as current prices. Why? Because you are multiplying it with the same the cost of the goods in the same year. So they will be called as current prices. However, if you multiply the number of goods with the prices in the base year, then what you will be getting, that is constant prices. So here in our condition, in our example, this 100 and this 120 was basically obtained after multiplying the cost of the goods with the prices in the same year. So these are what? These are nothing but these are current prices. Whereas here we are multiplying the cost of the goods with the prices in the base year. And this GDP which we got was the constant price. This was constant price. And if you effectively see this thing, here in the current prices, we have the effect of inflation, whereas in the constant prices, we have tried to remove the effect of inflation. And does this ring a bell? With the previous slide? In the previous slide also, we had discussed that from nominal, if we remove inflation, we get real. Similarly, from current prices, if we remove the effect of inflation, we get constant. So this is nothing but the concept of base year and the concept of the constant in current prices. In the case of India also, we have the base years as 2011 and 12. Fine. Let's move on to the next slide. The next concept is about concept of GDP deflator. Now this is a concept which is a part of both. It's a part of national income as well. as the part of inflation as a topic. So I chose to deal with this topic in this national income chapter. Let's dwell further into this. So GDP deflator, what is GDP deflator? GDP deflator, as the first statement mentions, it's nothing but the ratio between what? A ratio between numerator and denominator. Numerator will have GDP at current prices, and denominator is nothing but the GDP at constant prices. So they have current in the numerator and constant in the denominator. They have current in the numerator and constant in the denominator. And now from the discussion of the previous slide, we exactly know that current has the effect of inflation in it, whereas constant removes inflation effect from it. Constant removes inflation effect from it. And that's the reason why if we divide the GDP at the current price by the GDP at the constant price, what we effectively get is the measure of inflation in the economy. And let's read further, you will understand it. If the GDP at the current price is equal to the GDP at the constant price, the GDP deflator will be 1, implying that there is no change in the price level of the economy. Basically, there is no inflation. If the current GDP at the current price is the same as the GDP at the constant price, there is no change in the price level of the economy, and this will give you the this will tell you the effect of inflation. The next is GDP deflator. If it is found to be 2, it implies that the value of GDP at the current price is twice the value of the GDP at the constant price. Twice the value of the GDP at the constant price, and that's the reason why we understand, okay, the prices has increased by 2 times. So it's the prices have almost effectively become double. The price level is by a factor of 2, has increased by a factor of 2. If the GDP deflator, again another example, if the GDP deflator is found to be 4, it implies that the price GDP at the current price is 4 times the GDP at the constant price, and this gives you the effect that this basically tells you that the price level has increased 4-fold. They are multiplied by 4. So GDP deflator is more about, it gives you an it gives you an estimation about the inflation, the rising the prices of goods and services, and the last statement says that GDP deflator is acclaimed as a better measure of the price behavior because it covers all goods and services produced in an economy. Now, why do we say that GDP deflator is a better measure of price change in an economy? Because we'll be learning this more in detail in the inflation chapter, but we'll just to give you a brief, all the indexes which we use today are not flawless. They have some flaws. In fact, WPI doesn't even consider services in it. So inflation in the service is not even considered WPI. And that's the reason why this statement says that GDP deflator is a better indicator of the price behavior in an economy of goods and services produced in an economy. So I hope we are clear with this. So this is about GDP deflator. Moving on to the next slide. Okay, the next slide talks about the previous year's papers. So we have effectively come to the end of the discussion, end of the lecture, and let's move on. Let's discuss the previous year's papers. All these questions have been taken from the previous year's civil service papers so that you understand that what kind of questions are asked. You can digest this. In fact, the depth in which we have dealt, it's not the depth at which they ask the questions to, but we have just dealt it in that much detail. Why? Because I want to ensure this thing that none of the students who watch this lecture should actually face any kind of problem in solving these questions in the examination. Let's read about this. Let's read about the first question. The first question is the national income of a country for a given period is equal to what? It's equal to, now this is the question, and the total value, the answer to this will be the total value of the goods and services produced by its national. So this is the most suitable answer. The other answers you will yourself remove it. It is for example, let's read the second option, the option B, sum of total consumption and investment expenditure. No, we have never talked about this. We have never talked about consumption and investment. So this effectively is ruled out. The next is sum of personal income of all the individuals. That too is effectively ruled out. The next is money value of final goods and services produced. No, that is not the answer again. There is no mention of the period. There is no mention of the domestic boundary or the period. So effectively the first 3 options are ruled out. The first option is correct. The last 3 options are ruled out. Let's go to the next question. The next question is about increase in absolute and per capita real GDP. So it's talking about real GDP. Do not connote. Do ensure that you highlight these words in the examination. Do not connote a higher level of economic development. Why? Let's try to understand this. If industrial output fails to keep pace with the agricultural output, this seems to be a superfluous option. The next is agriculture output fails to keep pace with industrial output. This itself seems to be wrong. You see, try to understand the mindset of the examiner. He has deliberately put both these options, and both these options are meant to be negated by the students. If you have read about this concept. The next is poverty and unemployment increases. This seems to be correct. Why? Because country's economic development is not just measured in the terms of GDP, GNP, NNP, and NDP. So it's not just measured in these four terms. You must understand, even if the GDP of the country is rising, but still there is higher inequality in the country, there is higher unemployment, there is higher poverty, we cannot say exactly that the country is developed. Yes, the country has grown economically, but has the country developed? No, the country doesn't seem to be developed. So the country will truly, we can say that even if the real GDP is increasing, a higher level of, we cannot still say that it is a higher level of economic development. Why? Because the many people of the country are still lying in poverty and unemployment. Clear? Let's go to the next question, next slide. Okay, I want to particularly highlight about this question. I want to highlight about this question. This question we have seen time and again asked in the UPSC papers. Every 3-4 years they tend to ask this kind of question. The question is like, it's basically a contemporary question. It's more like current affairs questions. So with reference to Indian economy, consider the following statement: the rate of growth of real GDP has steadily increased in the last decade. And the next is the GDP at the market price or the market cost has steadily increased in the last decade. So this kind of questions, if that is the GDP has increased steadily in the last 10 years, the GDP at the market price has steadily increased in the last 10, this kind of questions are usually asked in the examination every 3-4 years. What I request to you guys, to the viewers, that whichever you are going for the examination, you usually, before your prelims examination, economic survey is already released. It's last week of January, the survey is released, and in the second part of the survey they generally have the table about the situation of GDP in that year and the previous few years, previous 5 years and previous 10 years. I just want you guys to have a look at that and possibly remember this thing, that in the last 5 years, last 10 years the GDP hasn't changed or something like this, so that you can deal with this kind of questions very properly in the examination. They are high frequency questions. Do prepare them in detail before especially you go for the examination. Okay, moving on to the next question. The next question is about the most appropriate measure of economic growth. We all know, we discuss it almost every day. It's nothing but the GDP. GDP is the most appropriate because we can make international comparisons, we can make cross-year comparisons. So GDP is the most. Besides, in net we tend to have depreciation rates also. So that's the reason why avoiding depreciation and avoiding governments in less reliability because of government change of depreciation. That's the reason why we prefer gross domestic product, GDP, to be a better indicator of economic growth in a country. Moving on to the next question. The next question, okay, it is about, in an open economy, the national income of the economy is CIGXM, stand for consumption, investment, government expenditure, total exports and imports respectively. What is this? So what is the formula? They had asked this question, and if you remember, quite frankly, in the slide of the GDP, I guess it was second or third point, and this formula was already mentioned. The formula of the GDP is nothing but C plus I plus G plus X minus M. So in this question, the answer is C. The option C is the correct answer. Then let's go to the next question. The next question is, which one of the following is the correct sequence in the decreasing order? In the decreasing order of the contribution of different sectors of the GDP in India. Contribution of different sectors in GDP of India. So we already know it's the service sector, which is the first, then comes the industry, and the last is the agriculture sector. So this is the sequence: service sector, then comes the industry, and then basically service is more than 50%, industry is roughly around 20 to 25%, and then comes agriculture around 10 to 14%. Moving on to the next questions, move on to the next topic. Now these are two topics which I have added in the later end of the slides. Why? Because these are the concepts which have not been asked until now. Besides, they are not that core concepts of economy which have been very frequently discussed in your books also. So let's just keep them in the later slides, so that and keep it as an optional. If in case you want to venture more in detail about this national income, you can read this. If in case you don't, you can skip this part of the lecture as well. So let's just discuss this. So it is about GVA. It's about GVA. GVA stands for gross value added, GVA. Now it has been seen that over the years the national income is measured in the form of GDP, but of late GDP is complemented along with the GVA, gross value added figures, to give a better picture of the economy. And what is this term? So just for the sake of the examination, let's just by heart few things about GVA. GVA is nothing but it is the measure of total value, total output and income of the economy. It is a measure of total output, and of course because of which, since it is a measure of total output and income of the economy, that's the reason why we are using it to measure the national income. The second point says that it provides the rupee value of the number of goods and services produced in the economy after deducting what? The cost of the inputs and the raw materials that have gone into the production of the goods and services. So it tells you the cost of the goods and services after deducting the cost of the inputs and raw materials which have been involved in producing those goods and services. So that's the reason why we call it gross value added, because if you remove the cost of the raw materials from the cost of the final good, you realize what amount of value is added. So that's the reason why it's gross value added. Moving on to the next point. The next point is about it also gives sector specific picture, like what is the growth in an area, in an industry or a sector of an economy. So that's sector specific. That's something which is to be appreciated about GVA. Besides, it also deducts, so remember these two things, it also deducts the cost of inputs and raw materials. And the last point, while GVA gives a picture of a state of economic activity from the producer side or supplier side or the supply side, the GDP gives the picture of the economy from the consumer side or the demand side. Fine, of course. Why? Because it is the supplier or the producer who will be knowing that how much amount of cost of goods involve the cost of the raw materials, how much of the cost of the raw materials upon which value addition has been done to make the final cost of goods. So of course it gives the picture of the producer side or the supplier side. So three things to remember from GVA. The first is it deducts the cost of inputs and raw materials. Second, it is sector specific. It gives you sector specific estimations of the growth in the national income. And then the third thing, it gives you the perspective of the producer side or the supplier side. Fine. So these things you need to remember. Let's move on. No questions asked until date. Yeah, and one more thing, the last thing, it's the approach of measurement of the national income, the approach of measurement. So there are three approaches of measurement of national income. The first is income or factor approach. The second is expenditure. And the third is value addition, production or output approach. Let's try to understand this. To measure the national wealth, you can either ask individually, every individual, that how much you have earned this year, how much you earned this year. Possibly every corporate you can ask how much you have earned this year, how much you have earned this year. That is nothing but the income approach. That is the income approach. You realize how much that entity or that individual has earned that year, accumulated all for the entire country, and you get what? You get the national income of the country. So that can be an income approach. It is also called as the factor approach. Why? Because there are four factors which, when accumulated, you basically understand the income of all the sections of the society. It can be what? It can be wages, or it can be rent, or it can be interest, or it can be profits. Wages for laborers and salaried class. It can be rent for those who give any kind of land or any kind of machinery on rent to someone else. So that can be rent. It can be either wages. It can be interest. Of course, the one who gives capital, he will be expecting interest. So interest, it can be the wealth can be gained, or the wealth can be earned. The income can be earned by interest, or by rent, or by wages, or by the profits. Of course, the entrepreneurs will expect profits. So these are the four ways in which the income can be earned. So that's the reason why it is also called as the factor cost, or it is also called as the income cost. The next is expenditure approach, wherein we don't ask the people about their wages. We rather ask the employers how much do they spend on the labor cost, or we ask the employers how much do they give rent, what amount of rent do they give. We ask the corporates that how much amount of interest they pay on the capital. So that's the other way around. You try to find out the national income of the country. If you don't get income or factor approach, we can also go for the expenditure approach. And the last one we already know, we have been dealing with it. The definition of GDP itself says it's nothing but the amount of goods and services produced within the monetary value of goods and services produced within the specified period in the domestic boundary of the country, final value. So that's nothing but the last approach. That is the value addition approach or the production approach or the output approach. I'm sure you are aware of this. We have been discussing it since quite some time. The next point I want to highlight is we have couple of times in the course of our lecture we have discussed about normal residence. So in the definition of GDP, in fact, we had considered that we will consider the domestic boundary of the country. We'll consider the domestic boundary of the country, within which we'll also be considering the normal residence, irrespective of his citizenship. He may be a foreign national, but he may be a normal resident of the country. So what is the criteria of being a normal resident of the country? You may be a foreign national, but if you ordinarily reside in India for a period of 1 year, so remember this figure, remember the figure of 1 year or more. So if you ordinarily reside in India for a period of 1 year or more, you become an ordinary resident. Besides, the second criteria is that the center of economic interest should lie in the country. The center of economic interest should lie in. So if you meet these two criteria, even though you may be a foreign national, you still will be considered a normal resident, and your contribution to the nation's wealth will be considered as the national income in GDP. I hope we are clear. So this was just a term which we had used in the beginning of the lecture, so I just thought of highlighting it back here. And the last is domestic territory. Okay, so do remember this, that in the GDP slide we had discussed gross domestic product, and wherein we had written about boundary. That boundary exactly didn't mean the political boundary of the country, it rather meant the economic boundary of the country. Let's try to understand this. The domestic territory refers to the economic territory, which is said to be a broader term than the political territory of the country. Broader term, it is a much more broader term than the political territory of the country. According to United Nations, economic territory is a geographical territory of a nation administered by a government within which persons, goods and capital circulate freely. So that's rather a broader term. It doesn't restrict itself to the political boundary of the country. It goes beyond. It's the economic territory of the country. So that's all in this lecture of national income. This is my channel UPSCpedia, and I thank you. This is me, Rishi Udeshi, signing off, and this is my email ID UPSCpedia. Just in case you have any doubts, do mail me, and thank you. Have a good day.